We have a special discussion at hand, and that is with the Neelkanth Mishra of Axis Capital. A lot of data points, commentary, etc., coming in on the macro front. Market in their own wisdom already at all-time highs back again going into the budget. So, a lot to discuss. Neelkanth, thank you so much for your time this morning. Neelkanth, let's first talk about India growth. I mean, we all know that we have a much superior growth than many parts of large economies globally, but recently we saw a commentary coming in from RBI Governor at the Bombay Chambers anniversary saying that probably we are witnessing as a country a structural shift in cusp of structural shift in growth upwards closer to 8% on a sustainable basis. Everybody has taken notice of this commentary coming in that we've had this kind of growth before in the past, but did not sustain. It was for a period of time. What would it take that kind of a growth to sustain in your view? Coupled with a moderate inflation environment, it could be a Goldilocks scenario for India. But people are, kind of questioning and discussing what would it take, is it possible, etc. As a practicing economist and strategist, what are your thoughts of high growth on a sustainable basis for India?
So this is very much in line with what we have been saying. So we started saying nearly a year back that India's trend growth assumptions are likely to be revised up. So if you recall, post-pandemic, many had concerns that the economy had been slowing to 6.5% even before the pandemic, and because of the scarring during the pandemic, that the growth rates would slow down further. And a 5 handle was what several people had in mind. We have been saying that the trend growth assumptions will be revised up, and it is very important to call it trend growth because when your GDP growth goes above, say if your trend growth is 7, if it goes above 7, it will not necessarily cause a lot of inflation, which is why trend growth as a number is very important. Now, I think we are in a good place. One of the reasons that we had seen the slowdown in the years before the pandemic was a very sharp slowdown in capital formation. So, as you know, there are 3 major components of growth. One is the labor input, the second is capital input, the third is total factor productivity. Now, our total factor productivity is growing very rapidly. It is growing in the 1.5–2% a year range. It's among the fastest in the world. Our labor force is also expanding very rapidly. And what is now starting to happen after a slowdown in capital formation pre-pandemic, we are now seeing the real estate cycle turn, the power investment cycle turn, and capital formation should be much faster as well. The question is, can we go further up from here? How do we compare to, say, the 2003 to 2008 period, where our 5-year CAGR, the 5-year compounded annualized growth rate, had crossed or had gone close to 8%, it was actually 7.9%. When you compare that period to where we are now or what we should anticipate in the next 5 years, and look at, say, labor input at that time was actually growing at 2.5 to 3%. Our labor force participation rates in the last couple of years has picked up again. There was a big drop between the 2012 to 19 period. But despite that, given that, of course, there's a larger population base and population growth has slowed as well, this number I don't think will be meaningfully above 1–1.5%. So there is automatically, so versus the 2003 to 8 period, the growth rate on labor input itself slows down. What is likely to compensate a bit for that is TFP. TFP growth at that time was a bit slower. In my view, I think the next 5 years should see much stronger growth. But unless we see capital formation really accelerate from here, I think it'll be very hard to see a growth rate which is substantially above 7% or so. Now, what can drive that? So what is it that we should expect? What is it that the government can do to create that acceleration in capital formation? Let's look at the headwinds first. See, 2003 to 8 was when there was significant acceleration in global trade. And trade and exports from India were very strong as well. There was a time, or there were a few years where just services exports were adding nearly 15% incrementally to India's GDP growth. because services exports, if you recall, IT services were growing at 20-25% a year. We are still seeing good growth. I think services exports are very strong, but on a much larger base and in a very large protectionist world, largely protectionist world, I think it's going to be hard to replicate that level of contribution to growth. But I think the bigger issue is going to be with goods exports. So goods exports had accelerated in the 2003 to 8 period. What we are seeing now, despite some very supportive and excellent policies, given that it's a much more protectionist world and you have China taking up a lot of market share again. So instead of China's manufacturing share of world dropping because of the China Plus One and all that, actually China in the last 2-3 years has actually gained nearly 2% points of market share in global manufacturing. And they continue to invest. So we've been flagging this risk that significant amount of capital that China was putting into real estate, and now, of course, the real estate market has slowed, so they're now redirecting it to industrial capacity. They've added $1.9 trillion of loans to industry in the last 4 years, and very likely they will add another $2.5-3 trillion in the next 5 years. So as we think about the world in the next 5 years, I think the pace at which capital formation is triggered by the opportunity for exports in goods and services is actually going to be a lot lower than it was in the 2003 to 8 period. There are ways to accelerate this process. So if, for example, we were able to improve, ease of doing business, significantly simplify our taxation structures for corporates, especially foreign firms, and equally importantly, work on urban infrastructure, because that is a space where significant amount of capital formation needs to happen. There is a big gap between demand and supply. And if we are able to get urban infrastructure investment to accelerate in the next 5 years, then I think potentially we can do a 7.5-8% growth, because that's an area where we need to invest. And if we are able to, it will also help sustain the real estate cycle for much longer. So there are ways and ways of getting about it, but I do see significant challenges in going well above 7%.
Fair point. Neelkanth, where does it really take us in terms of market cycle then? When we are already at a peak kind of a performance rate on growth, and higher growth from here on comes with its own challenges and to-do list. Market on the one hand are actually at a premium to other emerging markets, premium to many other globally well-traded markets. How much does it leave the PE expansion part of the market scope on that sense? Or unless and until the entire composition of the market does see growth acceleration on earnings, we are susceptible to some corrective phase?
See, what happens when PE multiples go up is, or actually, let's say there are two drivers of PE multiple expansion. The first is anticipation that future earnings will be revised up. So what may happen is that you think that the market is, say, X times FY26, but by the time FY26 becomes reality, the FY26 earnings have been bumped up by 10%. And because that happens, the market PE seems high ex ante, but exposed, it does not look that unreasonable, right? So that's one fundamental aspect. The second is a more, I would say, momentum or technical aspect, which is that if you see a disproportionate amount of savings going into one asset class, then the prices go up, right? And the PE multiples go up. And this is something that every asset class sees. There is real estate, which of course goes through very well understood cycles of peaks and troughs. And sometimes this happens in bonds as well, which are much heavily traded and are much more fundamentally traded. But let's look at the first one. I think in the context of the discussion we are having, when you see growth expectations get revised up, so say 1.5 years back, there were several people who thought India's real GDP growth would not be more than 5.5%, and therefore nominal GDP growth would be in single digits. And in this context, it brings in new sets of challenges. The debt to GDP starts to become unsustainable, lots of other risks come. So then there is a certain PE multiple that you could have justified. But as you start to see upgrades happen, and while no one really bothers too much about the last percent point of GDP when they are doing their company level analysis, but remember that FY25 GDP level has been revised up by 3% points. The real GDP of FY25 has been revised up by nearly 3% points over the last 1 year, which is a substantial revision. And what it does is it bumps up the demand for many goods, services, assumed demand for goods and services. And that upgrade drives a very positive momentum on PE multiples. So I think the assumption and expectation, which is why I think the PE multiples have actually held up despite the high cost of capital, the high risk-free rates in the world. If GDP growth acceleration cannot sustain, meaning that the upgrades to GDP are not really going to happen even further, meaning that we are already at 7.5. I think most people are now assuming that. Now, if we do not have the steam, given all the global headwinds and all the concerns that exist, of going above and beyond the 7.5 to say 8% plus, then perhaps this expansion in PE multiples may not sustain, and therefore we could see a period of a bit of time correction. On the technical side, or rather, let's say the flows side, generally, flows tend to be turbulent, and therefore they don't sustainably raise PE multiples. But what we are seeing, and what we have been seeing in the last 3-4 years, is a very steady stream of inflows, and which are still rising. So when I started flagging these so-called unintended flows several years back, I used to talk about $25 billion a year, $25 billion a year. Now, if you just do the maths, these numbers are like $40 billion a year. So there is a significant increase in this steady flow of funds, unintended capital flowing into equity markets. And this is a very powerful driver of PE multiples. So this is likely to keep the multiples elevated. Remember that deep corrections become very difficult when mutual funds at any point of time are sitting on 1.5 trillion rupees, 1 lakh crores of cash. So whenever there is like a 4-5% drop from the peak, there is a spate of buying. That drop in volatility of the asset class, meaning because the equities as an asset class is not seeing sharp drawdowns, actually in the short term makes it safer to invest in, and that attracts more funds. So that's the cycle we are in. I think it would be wrong to just look at PE multiples and say they're too high, which they are, and say that that's why they're going to be correct. But I do think that the first factor, which was a steady upgrade to trend growth assumptions, that may start to slow down now. And therefore, my view that we should see some time correction in the markets going forward remains intact.
Excellent explanation. Neelkanth, within the market, if one were to divide it in market cap terms, just for the better understanding, top 100 companies, which includes large and mega caps, and then the rest, which is broader market, and they are seeing a massive healthy addition on new IPOs, so categories opening up, etc. Which part do you see valuation versus earnings growth argument not in favor of?
So I still think that if it is a flows-driven argument, then it's very important to plot how flows are happening as a percentage of relevant market cap. And there I see that the flows to small cap and mid cap funds, and the measure we use is 12 months of flows, like the last 12 months of rolling 12 month flows, as a percentage of the market capitalization of that sector or that segment. So those flows for small and mid caps had actually reached 1%, 0.8 to 1.2%. That generally is the level at which we have seen historically those levels sort of falling off from, that is peaking at. So we have seen that now there is a bit of a correction that is starting to happen. Large caps, on the other hand, because of this preference, because incrementally savings are being directed towards small and mid caps, the flows argument on large caps is that things may actually pick up from here. And some of the things that we have seen recently, like the rebound in bank stocks, because the concerns around NIMs, etc., are kind of now fading. I mean, incrementally, not a lot of more pressure coming on NIMs. We have seen telecom tariff hikes. So in general, the large caps, to me, seem to be better supported than the mid and small caps.
Neelkanth, we'll talk about certain sectors in a moment, but right now the big focus for the market is budget. We are running up to the budget in almost 15-20 days. And the expectations after this government formation has happened is that the government may actually try to do a kind of a balancing act between prudent fiscal policies as well as kind of putting some cushion in the rural market. The rural economy, tier 2, tier 3 got badly hit. They need to be addressed. And this time they do have ammunition in terms of the big dividend from the RBI and the numbers, macro numbers which have come in. So how do you think it will be managed this time around in your view?
No, I have a difference of opinion with what consensus seems to be suggesting, that there will be, or at least some relaxation of the fiscal tightening that the government has been focused on the last several years. At the central government level, I don't expect this much of a change to the fiscal path. Remember that if you're a lot of the strengths that you see in the markets, or more than the markets, the fact that confidence of investors, confidence of foreign investors like FDI and the corporates is driven by macroeconomic stability, that your currency has been relatively stable, your fiscal path is of consolidation, your inflation is steady, interest rates are steady to falling. I think it will be, from the perspective of the government, there's no reason why the clear benefits we are seeing from the fiscal consolidation path should be frittered away or be given away. And therefore, my expectation is that the fiscal deficit number is likely to stay unchanged, or if at all, it should actually go down because of the RBI dividend that you mentioned. So it's a very a technical kind of transfer. It doesn't really change borrowing numbers, etc. that much, but still the 5.1 to 4. Meaning the demand supply for bonds that much, but the headline number could actually, there's scope for it to be brought down. It is also possible that the center increases the capex, the interest-free loans that the center provides to states for capex to be actually increased, given that there is more space. What the budget may also do is make meaningful announcements on the path towards the Viksit Bharat 2047, that if we have to think about developed India in 2047, what are the things that we need to do, and some announcements and schemes around that. Those would be my expectations from the budget. If there is more of fiscal transfers, I think that is very likely, or that is most likely to happen at the state level and not at the central level. You see what has happened, for example, in Maharashtra in the announcements in the new budget last week. And so if a state really wants to go down that path within the constraints imposed by the center, as you know, the center imposes under Article 293 of the Constitution effectively a 3% of GSDP limit on borrowing. So if the state wants to, within that limit, spend in a certain way, I think they have complete flexibility, and that is what Maharashtra is utilizing. But at the central level, I don't really see a change I don't really expect a change in the fiscal path.
Right. Neelkanth, what are your thoughts on this macro environment is translating into stable macro environment? And you mentioned very rightly, corporate after corporate we've interacted on the channel does praise this particular factor which is playing out for India. How is the earnings trajectory looking for corporate India in this light?
So earnings are doing well. FY 25-26 EPS was broadly unchanged in the March quarter. FY 26 was actually bumped up a bit. Some of it, my fear is that the analysts, in trying to justify higher target prices, are perhaps going an extra or becoming overly optimistic on FY 26. But the trajectory of earnings is quite stable, and I think mid-teens kind of earnings growth, say 13, 14, 15% for the next 2 years looks like a reasonable assumption. And I would expect that as the economy, I mean, there are weak spots, there are strong spots. As you know, there'll always be a mixed bag, but I think a 7% plus real GDP growth number seems sustainable. We should expect 4 to 5% inflation at least, and that means 11-12% nominal GDP growth. Given that at this stage of development in the economy, there is some increase in inequality, so capital share of income goes up, labor share of income falls, and therefore earnings as reported should be growing a bit faster than nominal GDP. So that's the broad top line view that I have, and therefore when I see that consensus is at 13 to 15% growth the next 2 years, I think that seems like a reasonable number.
Neelkanth, are you witnessing some green shoots, as even the RBI governor did mention in his speech after the policy, in the rural side? And will that green shoot actually translate or start reflecting in the corporates which are representing the rural or tier 3, tier 4 India in the next couple of months?
See, I think we have discussed this in the past. I don't find the rural-urban divide very useful analytically.
Okay.
Just to give you a hypothetical example, because now rural households in Bihar and every household now almost seems to have a motorcycle, and almost every village in India now has a Pakka road connecting to the nearby tehsil town or big town, right? Now, if someone picks up their motorcycle, drives, say, for 5 kilometers or 10 kilometers and buys something from a township, now is that rural demand or is it urban demand? And this is why this divide that seems very intuitive, rural versus urban, I mean, maybe it was meaningful 20 years back or even 10 years back, but it's no longer very useful. What is useful is lower income versus upper income, because I think urban poverty is as much a challenge as rural poverty is. In fact, rural poverty from a policy perspective is easier to address through NREGA and Pradhan Mantri Awas Yojana and all that. It is much harder to do so in urban India. So the question is, will there be a pickup in the demand for goods and services which are consumed by the lower income households? I think that the fact that GDP growth is 7%, I think it should flow down to everyone. But my expectation is that at this stage of development in the economy, there is a natural increase in inequality that emerges, partly because there's so much of labor transitioning from informal sector and from agriculture into formal sector and industry, and therefore the pricing power for labor is a lot weaker. Cyclically also, while we have done very well and as we've been discussing, our trend growth rates are far superior to what people had feared, and RBI is also corroborating that. The fact is that we are still about 7-9% below where we would have been if the pandemic had not happened, and which means that there is almost a year of extra workers in the economy, and that means that the pricing power for labor. So it's not just those 1.5 crore people who entered the workforce and have not been able to find work. It is also the impact they have on the earnings power of others, because the demand supply gets distorted. And because of these factors, I expect that the consumption by the lower income households will grow slower than the average GDP. So the GDP on average. So that's how I would look at it. That GDP grows, I think it helps everyone. It helps some more than others because capital share of income will go up. And therefore, the top line growth for FMCG companies, which was say about 6.5% in the last 2 quarters, I don't expect to move meaningfully. The fact that price growth has slowed and therefore volume growth is picking up is great, but the mix, in fact, the space for it to grow more than high single digits looks very different.
Excellent point, Neelkanth. It's not urban versus rural anymore. It is lower income versus higher income, and urban poverty actually is also something we don't talk much about, but it is prevalent. Neelkanth, before we let you go, just a quick answer on where are you most comfortable on in terms of sectors and where earnings growth versus valuation argument is very comfortable, and which ones are you least preferring right now because the argument has run out on its course?
So those preferences remain the same. So financials and utilities are the 2 sectors where we find that versus their own trading history in the last 10 years, the PE multiples compared and the standard deviation. So if you adjust for that, the 2 cheapest sectors are financials and utilities, and we find that sectors like IT are in that sense overpriced on the same measure. There's a great set of companies, but as stocks, and especially given what we think is likely to happen to their earnings assumptions going forward, we think those seem to be the most overpriced.
Excellent, Neelkanth. Always enjoy our conversations. Thanks so much for your time.
Thank you, Ajay. Thank you for having me.
If you like this video, then like, share and subscribe to ET Now.